Three major market forces are set to collide in a single morning, and the outcome could move stocks, bonds, and the dollar sharply in either direction. Tuesday brings the Consumer Price Index, the first wave of big bank earnings, and fresh commentary from Federal Reserve officials, all arriving in close succession. That kind of compression is rare, and it raises the stakes considerably for investors trying to read where the economy and interest rates are headed. Start with the CPI. This is the government's monthly snapshot of how fast prices are rising for everyday goods and services: groceries, rent, gas, medical care. Inflation has stayed above the Fed's 2% target for an extended stretch now, which means every new reading carries real weight. If prices came in hotter than expected, bond yields tend to rise and stocks can fall, because a hot number signals the Fed may need to hold interest rates higher for longer. If inflation came in cooler, the opposite tends to happen. Rate cut expectations build, and risk assets like stocks often get a lift. Layered on top of that are quarterly results from some of the country's largest banks. Bank earnings matter beyond the banks themselves. These institutions touch consumers, businesses, and credit markets all at once, which makes them an early window into the broader economy. The key questions this season are higher interest rates starting to squeeze borrowers. Is loan growth slowing? Are there early signs of stress in credit quality, meaning more borrowers falling behind on payments? Then add the Fed. Officials are still speaking publicly as markets try to judge when the central bank might actually begin cutting rates. Remarks from policymakers can either reinforce what the inflation data implies or complicate it. That ambiguity is part of what makes this week's setup unusual. The risk, when all three arrive together, is conflicting signals. A softer inflation print could suggest rate cuts are getting closer, but if bank earnings show economic strain at the same time, the mood can turn cautious quickly. On the other side, strong bank results paired with stubborn inflation could leave markets without a clear direction to move. Bond markets may feel this most acutely. Treasury yields, which move in the opposite direction from bond prices, have been sensitive to every inflation and Fed headline for months. Equity investors watch yields closely for the same reason. When rates rise, stocks face more competition from fixed income returns. The practical lens here is straightforward. Watch not just the CPI headline number, but how the Fed and the banks respond to it. When three data streams arrive at once, direction comes from how they align, not from any single reading in isolation. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.